Everybody learns from someone else. And so I originally came across analysis by Ray Dalio years and years ago, because my research was aiming at, okay, so we're building more and more debt in the system. How does this end? What are the different end games for this particular cycle? Not the end of history, but the end of this, period of time. And I found that he had the most kind of complete explanation. And so I eventually looked at that thesis and then said, well, let me dig into the numbers myself and see if I can reconstruct it and see if I can look at it from other angles, right? So kind of inspired by one thing and then try to add value to it. And so all of my research kept pointing in that same direction, where you go through these periods of long-term debt cycles. So you build up, you have the short-term credit cycle, you build up debt in the system, then you get some sort of event or some sort of, say, monetary tightening cycle that kind of washes it out. You get a period of partial deleveraging, but then you start building up debt again. And you never go back to your baseline. Instead of a sine wave of debt that goes sideways, it's like an upward trending sine wave. And so you get higher and higher debt as a percentage of GDP and lower interest rates until you hit zero interest rates or even slightly negative, and you get extraordinarily high debt levels. And historically in history, when you hit that sort of period, you get basically currency devaluation, debt monetization, and financial oppression, which is basically that you start to get large fiscal expenditures and they hold interest rates low. And so you get pretty high inflation, pretty high nominal GDP growth because the large inflation component, while they're holding debt well below the inflation rate. And so because basically if you have 100% or 150% debt to GDP, if you do the math on interest rates, you can't really have structurally positive real interest rates. And so you get that period of financial oppression. And then if you tie it even back to longer cycles of just kind of like debt jubilees or wealth concentration cycles that literally you can evidence that back thousands of years to ancient Greece and the Near East, humans just go in these big cycles. And so my kind of research has been based on the idea that we are in one of these cycles and that most people looking at 20, 30, 40-year back tests are kind of missing the bigger picture. And I think that's starting to become more apparent, but it's something that I've been focusing on for about 2 years There's now. That old quote that history doesn't repeat, but it rhymes, right? So my point with the 1940s is not that we're going through an identical period, but that it's the closest period that we should be familiar with. If we're basically things that seem shocking are less shocking in financial markets to you if you are familiar with the 1940s. You're like, oh, it's kind of like what happened there. And so it's basically the closest template we have. And then the question becomes, how do we differ from that template? What are the differences? Because it's not identical. And one example is that back then the United States was running structural trade surpluses. And the UK, the existing power at the time, was the one running structural trade deficits. And so now in many ways, the United States more resembles the UK from the 1940s, where they're the leading power, and they have the structural trade deficit against a rising power, which back then was the United States, and now is China. And that doesn't mean that it's going to follow the same exact pattern. There's obviously different geographic differences. There's all sorts of differences there, but there is kind of a semblance there. And generally, what I was seeing was I wasn't talking about kinetic war, but I was talking about essentially wartime finance, where back then you had very large fiscal expenditures that were monetized and it was very inflationary and it was very commodity heavy. And what we were seeing in response to a pandemic hitting a highly leveraged system, right? Because, humanity's had pandemics in the past. And if you don't have a lot of leverage, it's not that, it's obviously still bad from a humanitarian standpoint, but from a financial standpoint, it's not the end of the world. But if the whole system's so tightly geared and there's so much operational leverage and financial leverage that it can't absorb shocks, right? It could be anything. It could be a natural disaster. It could be a virus. Could be a war. If something hits a system that levered, you get these. Basically the system cannot let itself collapse. Credit markets are based on always expanding, and that's why these kind of recessions have gotten kind of shorter and crazier with bigger and bigger government responses. And so when you're kind of at the long-term debt cycle, you're already at the zero bound in terms of monetary policy, and you get a big shock to the system, you get a massive fiscal response. And so it looked like wartime finance, even though we weren't in a kinetic war with another country. We were at war with, biology, essentially. We were at war with just saving our leveraged system. And I was hoping that it wouldn't turn into an actual kinetic war, but the other thing I was looking at was, so I'm quantitative. I focus more on the quantitative side, but I also pay attention to the qualitative side. And so, for example, there's a book called The Fourth Turning, where they look at cycles from a demographic standpoint. It's his two historian demographers wrote that, and there's some aspects that seem, you could say it's wishy-washy, but it becomes more interesting when you say that. So their argument is that every roughly 80 years, you have kind of a generational crisis where prior institutions get torn down, new institutions get built, the social contract gets destroyed and renewed. And it could be good or bad. I mean, you could replace a decent social contract with a worse social contract, or you could build something better. And what I noticed was that all of his, quote unquote, fourth turnings, his crisis standpoints coincide with long-term debt cycles, right? So basically, in all those long-term debt cycles where you get kind of a big shift in monetary policy, you also have rising populism and things like that. And so it's not surprising that you get wars in those periods. And basically, those wars are kind of the catalyst. And, I was hoping that this period would be one without a kinetic war, and that it would be purely kind of, humans versus nature or humans versus their own leverage, essentially. But now, yeah, we're throwing kinetic war into the mix, and so it's unfortunately even closer to the 1940s. And now I would say hopefully the war doesn't get anywhere near the scale as it was in the 1940s. But you do have a lot of you have protectionism, you have increasing geopolitical contact after a period of relative harmony, and you have a highly leveraged system. So in many ways, it just continues to resemble the 40s, closer than I could have imagined. So my base case throughout the 2020s is that we'll have higher than average inflation compared to the 2010s, um, driven by just commodity supply limitations, large fiscal spending, that 1-2 punch. And then generally when you have new technologies and sovereign debt crises, that's when you get shifts in the monetary system, right? So the prior shift was the 70s, the one before that was the 30s and 40s. And so I do think that we're on the verge of kind of another monetary transition. And to your point, one of the arguments I made is that this period is pretty unusual, where we have like one fiat currency at the heart of the whole system. People assume you have to have like, what is the world reserve currency going to be? And it's like, well, this was the anomaly, I would say, that basically after World War II, the United States was like 40% of global GDP.
Yeah, got it.
And
Yeah.
whereas right now it's down to 20% of global GDP. There's no country big enough to be the world reserve currency alone, and nor do they want to. Nor is there enough geopolitical consensus and power concentration to have a hyperpower that can just dictate terms, right? So I think we're heading in a more multipolar world, which includes a multi-reserve currency world. So you can look at, say, the SDR basket. That's 5 major currencies. They're kind of the reserve currencies, and the United States dollar dominates it. But I think over time it spreads out a little bit. We've already seen that mildly for 20 years. So the US dollar share of global reserves hit a peak about the year 2000, and it's been in a kind of a sideways to mildly down trend. And I think that continues, could accelerate. And I also think there's going to be an increase. There's ever since around 2014, there's been an increasing shift towards neutral reserve assets, which currently means gold, meaning that if you look at official central bank holdings of treasuries and gold, both have gone up in dollar terms, but gold, they've been buying gold and their gold's been appreciating. And we see, for example, with this recent event that, treasuries were considered risk-free assets. But if now we see that if you are a country that is belligerent, or a country that is, for whatever reason, not on good terms with the US or Europe, and that can take a variety of forms, right? So right now we're saying, okay, if you do something extreme like war, your reserves could be frozen. But in the future, you have to say, okay, what would future politicians do with reserves, right? Could we freeze the reserves based on trade disputes? Could we freeze them based on commodity disputes in a truly scarce world of commodities? And so countries are saying, okay, well, so if my reserves can be frozen, they're not risk-free, and they're already yielding below the inflation rate, as we just discussed. They're being financially oppressed. They're just melting ice cubes. So what other assets can I put reserves into? So one option is you could go into a couple different currencies. So Russia, for example, had their dollars and euros frozen, but their yuan and their gold is still fine, right? So you can do that. And then 2, you can get into gold. And gold is really the only commodity market big enough to be like a long-term store of value. Even then, it's not really big enough. It's, if you do the math on what it would take for China to go to an official, and now some estimates think that China has more gold than they say, but let's just take them at their face value. And they say, okay, they want to get up to a 20% weighting of gold reserves as a percentage of total FX reserves, like Russia has. What would it take? Well, the gold market's not really big enough to absorb that flow without a big price increase. And that's just China. What if every country wants to go, in whatever allocation they have to gold, they want to increase it by 20%. This is not a big enough market. And then you can look at things like Bitcoin and you say, okay, there's a neutral reserve asset. There's a payment channel that's relatively permissionless. That obviously has interesting geopolitical locations as a kind of a reserve asset, but it's a less than $1 trillion asset right now. It's not big enough to absorb that. So I think as we look out further, we are looking more digital. Gold is important now. I think part of it is having it in your own jurisdiction. So no stable coins, no paper claims, but just having it in your own country vaults is important. But for people and for other institutions, I do think that we do have a variety of gold-backed stable coins. I think you can have other commodity-backed stable coins. They're interesting. Obviously, you have fiat-backed stable coins, and then you have bare assets themselves, like Bitcoin. And I think that there's going to be kind of a transition over time. And my general approach is to focus on scarce assets. So I like gold, I like Bitcoin, I like appropriately priced real estate, I like appropriately priced equities, commodities, things like that. And I do think that we're going into a world where reserve practices are more diversified and perhaps more focused on scarce assets and even things like just higher commodity inventory, strategic commodity reserves, things like that. I would say we're in the process of testing Bitcoin's hardness. So if we go back to gold for a second, right? I mean, if there's 200 trillion in bonds and cash, there's something like 12 trillion in gold, right? So if you were to pour some of that big cup into that smaller cup, gold would have to be much bigger to absorb it. And in the 70s, you had crazy shocks. Like you had gold go from 35 an ounce pegged up to hundreds in a very short period of time. And then it, eventually reached a bubble and then it stabilized. And then it kind of went this long period where the treasury was the reserve of the system. That started, like we said, that kind of peaked in 2000, which is also roughly when gold bottomed. That was like the UK sold part of their gold at the bottom of their official gold reserves. Then we had this like decade of almost straight up in gold, right? So you can have things like where decades happen in a year, and then for decades nothing happens, right? So I do think that you have these periods of time. You know that quote, like there are weeks where decades happen and decades where nothing happens, or decades where weeks happen. I think gold and these kind of monetary shifts happen like that, where these markets can get big enough if the much larger asset becomes far less desirable, and just money has to keep pouring into those new assets. And so bringing it back to Bitcoin, I think it's we're seeing it's monetizing over time. Right now, it's a 13-year-old asset, right? So we can't just put $1 trillion into it and say, okay, well this is our hardest asset ever. It's our sovereign reserve. This is where we're putting decades of accumulated trade surpluses. We're betting the future of our citizens' like financial lives on this asset.
Yeah.
So
I want that, but what you're saying makes sense. But yes, I hear you.
So we can barely do it with gold, right? So gold is already like, gold's historically been the safest asset you can imagine. But now this question's like, could gold be demonetized by Bitcoin, right? So there's nothing that's risk free, right? But gold has, it's got the longest history. It's this super stable stock to flow ratio, closest thing we have to perfect money. And so they have that. Even that market's not big enough. And so as we're seeing Bitcoin monetize and we're testing its hardness in various ways, we're seeing, okay, how does it respond to differences in hard forks? How does it respond to 1,000 altcoins trying to basically denial of service it, or just like a distributed attack on it? Can we dilute it with altcoins? Then we're seeing, okay, what if some countries try to ban it and other ones? So we're kind of going through a process of seeing how hard it is, right? So the longer it goes, the more benefits from the Lindy effect. And it also reaches a higher adoption, so it can kind of slow down its volatility over time. And if it becomes a multi-trillion-dollar asset and then it's been around for 20 years, that gets more interesting, right? So I think over time, Bitcoin can become big enough if it continues to show that it's hard enough and that it's sturdy enough to support that kind of capital. I think in the meantime, gold is kind of the present option that central banks have. They could drive the size of that market up by 50% or 100% in a pretty short period of time. And then Bitcoin has to get multiples bigger in order to kind of serve a similar role. I think that's a big test. I mean, one thing that blockchains do is they kind of decentralize finance, right? So for example, stable coins make it so that people can send international payments peer to peer without going through central bank, them sending money to each other, right? Just peer to peer over the internet. And the same thing's true for Bitcoin. And then the same thing's true for countries that want to raise finance. They can raise finance from hedge funds and individuals over the Liquid network, for example. And I do think that's a test to see how it turns out, because right now one of El Salvador's biggest risks is that their sovereign bond yields are blowing out. They've been down, their bond market's been downgraded by rating agencies. There's not a lot of appetite from foreign official channels to buy their bonds at the moment, and so they have somewhat of a long-term refinancing risk here. And so we'll see how they're able to shift the type of market that's interested in them.
Okay, so what about this thought? What about asset confiscation by governments by the end of this decade? Do we get to a point where governments get broke? A country like Canada is saying, hey, listen, we're broke. And we're going to confiscate some assets. And the reason I bring that up is someone who I think is really level-headed with this type of thinking is Jeff Booth. And in talking to him a few times, at the end, he'll sometimes allude to, and I want to talk to him about this further, about asset confiscation, that we're kind of on that path, that perhaps this is a real thing. And in Canada this year, which I'm sure you've heard, some citizens had bank accounts frozen for over, a $50 donation to a protest, and they had their bank accounts frozen over that. And that really kind of propelled my thinking forward, thinking, holy smokes, if governments get desperate enough, now we see what's happening with Russia's reserves, but we're seeing some citizens get bank accounts frozen over $50. Maybe this idea of asset confiscation by governments 10 years from now isn't as, out there as I once thought. What comes to mind when I say that to you?
So that was a risk throughout the 30s and 40s. And it's a risk again. When you have major transitions, there are risks like that. And generally they will try to disguise it, right? So for example, to add to your list of examples, we're seeing now, so energy companies had a terrible 12 years, 10 to 15 years of returns. There are energy stocks that are cheaper than they were in like 2007, 15 years later. They went through periods where they had negative earnings, they had to write down losses. Now they're in a period where they're actually earning quite a bit of money. And some countries are coming in and say they're gouging prices. We have to do windfall taxes. We have to, now that they're actually having a good couple years, we have to do windfall taxes. So that's another example where you can have kind of changing the rules or narratives shifting around how to provision the government more, right? And it could be, let's say Bitcoin goes up 5x. It's like, well, all these rich Bitcoiners, let's do a windfall tax on the Bitcoiners. Or gold went up so dramatically, let's do an extra windfall tax on gold. Or
real estate in Canada. Real estate in Canada is one of those things. Yeah,
exactly. Real estate in Canada, or just, hey, like, look, wealth concentration's never been wider. We're going to do a windfall tax. So there's all sorts of things that can happen in these environments, right? And there are ones that could make sense, right? I mean, they got through the 30s and 40s in the Western world pretty well, all things considered. There are things that can make sense, and there are other things that are just out there that just they risk kind of the rule of law, or they risk kind of perception of the what is investable, right? So for part of the reason that nobody wants to own Chinese stocks right now is they spent a whole year just constantly changing the rules around how they're going to treat their big companies. And now they're saying, hey, we want to wrap up regulations, we want to respect property rights, we want to encourage international investment. And they might come back, but it's like it takes time to then build that trust again, right? To say, okay, what do I own if I own Chinese companies, right? And so generally one of the strengths of the West has been that you have pretty strong rights when you own property throughout Europe, Canada, United States, countries like this. And if you do threaten that, that can have implications for the ability to raise capital in the future and to get things done. So I think when you have decades of stress, like I think we're probably going through with commodity shortages and inflation and kind of the breakdown and some fiat currency, starting with the weaker ones and then kind of moving towards the main ones, you can get pretty extreme actions, and you can get kind of rising populism on the right or the left. And that can encourage kind of extreme behavior if you start to get kind of a very strong political consensus. I think they want to be able to buy oil in yuan. I mean, that's one. And so going back to what we said before, for most of this multi-decade period of, post World War II and then, including post 1970s, the United States was by far the biggest share of global GDP and the biggest commodity importer. And then over time, as we've seen the rise of China, which has 4 times the population, so even if they have less per capita, they're still bigger. They have more skyscrapers, they consume more electricity. In many ways, they're already bigger in terms of, say, purchasing power parity GDP. By kind of raw consumption, they're already bigger. They're the biggest commodity importer now. And the United States also, because we've developed shale, we've also kind of limited our exports, I mean imports to some extent, and so China has surpassed the United States as the biggest customer of a lot of oil exporting nations, including Saudi Arabia. And so one of the things that they can argue for over time is that we want to be able to buy oil in yuan. And so we see headlines where Saudi Arabia is considering it, right? When it's kind of the customer's always right. If your biggest customer asks something, you at least consider it. Um, and now that you have Russia cut off from the West, uh, they can gravitate east, and that gives China some influence to say, "Hey, Russia, I see you have some oil over there. We have yuan, and you can use it to buy electronics and manufacturing components, and so let's make a deal, right?" So I do think that's part of the long-term trend towards a currency world. Now, the biggest shortcoming of the yuan is that because you have restrictive capital controls and just less property rights, rule of law, there's less things you can do with your yuan. So with the dollar, all these countries get dollars, and then they used to plow it into treasuries. And when that kind of got like a bad trade because of the low yields and compared to inflation, they started piling it increasingly into equities. And they also, they go to Canada and Australia and they pile it into real estate, right? So there's some markets where, in the US it's stocks, in certain other countries it's the real estate. And in China, foreigners have not wanted a ton of their assets, right? So that's been the challenge. But I think over time, if they can get a handful of key partners, it doesn't take everyone, it just takes key partners. They're already the world's biggest trade partner with the majority of countries. If they can convince them to say, okay, hey, hold a percentage of your assets in yuan-based assets, then they
Makes
start. This
makes
is
sense.
this is fluid, right? Because as we get more information, this can change over time. But my base case now is that we're going to see a spectrum across the world. So in China, central bank digital currencies are already here. They're just kind of been arriving over the past couple of years with testing and kind of rollouts. And so China is capable of doing it partially because they started researching it in 2014. So there's like kind of a long cycle for that. It's not something you just put together in 6 months. So as the rising power that doesn't really like the current system financially, and as a country that very much likes surveillance and control, they viewed central bank digital currencies as a natural fit. In the West, it's more challenging, right? So the ECB published a document back in 2020 talking about the benefits of CBDCs and what it can mean. It can give them more seniorage. They can basically take market share back from banks. They can surveil and control more. They can do kind of more deeply negative, below zero rate policy. It gives them more tools, which if you're on the other side of that, sounds terrible. But from their
Yes.
perspective, they like it. And then
Once again, Lyn, you're saying it very factually, and I'm freaking out over here. But yeah,
yeah,
I agree with you totally.
and then in the United States and Canada, I think that kind of the further west you go, I think I view it more as like stable coins because you know as you head west, you get more kind of governments less willing to operate large technical things themselves and more willing to partner with industry to operate it for them. And so I see, for example, regulations try to make stable coins more backed by kind of by more provable reserves. Maybe only banks can issue them, or maybe you have to have them 100% banked by cash and treasuries, for example, and that they can incorporate those into the system. And then those are kind of an arm's reach central bank digital currency, right? So for example, large banks are obviously going to comply with government regulations in the United States and Canada, and so I think that, and then they can hire technical providers to kind of administer the technical details of stable coins. And so I see that as the most likely case, especially I don't follow Canadian politics quite as closely as American politics. In the United States, we have a very tightly divided Senate and House, and basically we don't really have enough consensus to do anything, um,
Yeah.
which is good or bad depending on what topic you're looking at.
And
And
we just copy what you guys do. That's how we operate. Just so you know, that we just copy what America does.
So yeah, so I mean, to the extent that's the case, I see basically just because of this political division, I think you tend towards that private public partnership where I see stable coins being more relevant in the West and CBDCs being more relevant in say places like China, and Europe's maybe a little bit between the two and still remains to be seen. I think you can see a spectrum of government control versus kind of, we've been in a
Yeah.
40-year period of disinflation, which doesn't mean deflation, but it means lower inflation compared to, the end of the 70s, and consequently lower and lower bond yields and rising debt to GDP. And that goes back to the long-term debt cycle I talked about. And so a lot of back tests, a lot of assumptions about equity performance and real estate performance, all these different asset classes, they've had this 40-year tailwind of lower and lower interest rates, which when you use interest rates as a discount rate, it basically as they go down, it lets you value other assets more highly, and it makes financing costs cheaper. So you can have a higher house to income ratio. You can have a higher stock market to income ratio. You can as yields go down, things get more and more financialized, and it's a structural tailwind for assets. And if as we hit roughly zero, some countries you hit negative, and if you just start going sideways on yields, let alone if you start going up in yields because of inflationary pressures and things like that, uh, that can be a headwind for a lot of assets. And so kind of the chart of truth is looking at the long-term US Treasury rate and see that it's been in this very tight, 30 to 40-year downtrend. And that every once in a while it kind of it tests the upper bound, it tests the lower bound. It's been oddly perfect. And right now, as we've been in this inflationary environment, as bond yields around the world have pushed up, among other countries, the US Treasury yield is poking the very top of its channel. And so a lot of people are looking at it and say, okay, we just kind of bounce off that again, or are we going to break out into a new type of structure? And so my base case is that, we're going to be probably a choppy sideways period for a while in yields. I don't think we're just going straight up to like 8%. Um, I think we're going to chop around for a period of time and just be under the inflation rate broadly. But that has implications for all sorts of asset classes around the world. That basically the structural bull market is more challenging now going forward.